Now we come to that category in the middle,
Yeah.
okay, which people have discovered a lot in the last, I think, couple of years. I haven't had discussions on balance advantage and hybrids and multi-assets and whatnot then recently than ever before. But now apparently they've become the thing to be in because they give you best of both worlds.
Yeah, I think, my first submission is when you look at the product called BAF, and that's when it started the discussion on asset allocation. Please understand, though it might be asset allocation product, it is an asset allocation for the fund, not for you. Right? Please differentiate that.
Very important.
If you want the fund to be your asset allocator, then you have to follow the asset allocation of the fund.
Yeah.
The BAF is a good product for downside protection of the market. And there are people who want that. And if you want that, that's a great product for you. But the last 2-3 years of biggest unlearning for me as a salesperson has been the multi-asset. Because I've been guilty of standing up in a number of stages and saying equity is the growth product and you should buy that. But if you compare the last 10 years of gold versus the census, the gold is outperforming. And that's where this data of if you want a median return, it is far better possible through a multi-asset product than a pure asset product. Even if that pure asset is equity.
Yeah.
That median return possibility or probability of gaining that is far higher here because next year for all you know debt and gold might outperform equity for all you know. I don't know.
Yeah.
But the possibilities there are looking far brighter, right? And a fund which is allocated there will start giving you the best of all these worlds, like you rightly pointed out, bringing back the merits of asset allocation to the basic discussion. But from a hybrid which is static to the equity savings, which is at the bottom end of the risk profile, to the BAF and the multi-asset, the hybrid does give a fair amount of options to investors and the risk profiles are mitigated. So from a portfolio ownership, just take away the asset allocation part. On merit, each of them stand a very good ground on the asset allocation.
Yeah. But be aware why you're investing in them.
Yes.
Know why
they stand for it.
Yeah, because what happens is that when the market falls, now you suddenly discover this category.
No, but you shouldn't be invariably that's what happens. Hybrids come into vogue when markets fall. But if you look at the long track record of hybrids, they have stood the test of the ground on absolute returns by themselves. So they are great funds, and I'll give you a great example of balancing and the hybrid. Our hybrid is 70-30. It balances once in a year.
Okay.
Over a period of time, just the sheer balancing of it coming back to 70-30 every year has added more than 1.5-2% to the return of the portfolio.
Wow, just the rebalancing.
Amazing.
I didn't think it's good that sometimes I just wish that this learning would happen not with the market movements. You should know this any which way.
Yeah, it's simple.
Because if the market is down 30% and you discover the attractiveness of a balance or a hybrid, thinking that this will protect me.
See, if you go by pure asset allocation grid, just taking that 70-30 example, markets have rallied 10%. That means your 70 has become 77.
Yep.
That means either you cut 7 rupees and get it to debt, or your fresh allocation of 7 rupees
should go into debt.
Yeah. If you follow that grid, you know your next investment. If you follow the market, it is mindless. See, there's this saying, that 95% of your returns come from asset allocation and 5% comes from markets.
Correct.
But 95% of discussions happen on the market and 5% on asset allocation.
Which is why I want to end this episode on the very important and interesting point that you made on risk mitigation versus portfolio return generation. Sorry, why for a lot of people here that 4 years bull market has happened and everything is going up and India is the best place to be. So it is return generation. But mutual funds, as we started this episode, by the way, folks, is about risk mitigation. Please spend some time explaining that.
No, I think, like I said, when we start, we think it's a process of return generation. But it is actually a process of risk mitigation. The closer your portfolio is to your risk profile, the better the investment journey. If it is closer to your risk profile, you are more comfortable with it. Hence, you can spend more time in it. The more you deviate for that, the more it is liable for changes. And time is more important than timing the market. Everybody says that.
Yeah.
But it's difficult to do that because of deviation from risk profile.
Yeah.
If you are comfortable with something, you will hold on to it.
Yeah.
So sooner you realize it, it's easier said than done. I took a long time. Actually, I realized it when I was 40. And after that, I mean, I'm a ruthless rebalancer of portfolio. And I hold allocation, irrespective of market fall. My fresh money can go to rebalance the other asset class. And because I'm comfortable with 12% return. Now, if you tell 12% in these markets, people will laugh at you. But that is what will take me to my retirement kitty.
Yeah.
Please understand that used to be 11%, but because of some lifestyle changes which happened, I had to move it to 12%.
Yeah.
Also, I had to move my 70-30 portfolio to 60-40 portfolio to 70-30. So, understanding your lifestyle changes and incorporating that in your portfolio can be a better way of looking at it.
And you've given valuable advice to the guy who's just starting off his mutual fund journey. Like you said that learn from the market, which is that start with passives. Maybe it's going somewhere there.
And the core funds, large cap, flexi cap.
Yeah. So, folks, there's your advice. If you're just starting off your mutual fund portfolio and understand how mutual funds work, select properly, and then, of course, enjoy the journey.